Welcome to the first episode of Conversations with Jeff. Here with me today is Ben Gadon, Managing Director of CBiz MHM. Ben has over 30 years of tax experience, and right now, this is the perfect time to speak to Ben because one of the hot button topics in real estate are the new tax laws and how exactly that affects real estate transactions in the residential market space. So Ben, first of all, thanks for joining me.
Thank you, Jeff.
So let's jump right into mortgage deductions. So we know now any home purchased this year through 2026, you can only deduct up to $750,000 of the mortgage interest. How has that changed from last year?
Well, Jeff, under the new rules, the acquisition-related and interest on acquisition-related indebtedness is limited to the first $750,000 used to buy your personal residence or a second home. So any interest on anything above $750,000 of borrowings is no longer deductible. In addition to that, you used to be able to borrow $100,000 of a home equity line of credit and use it for whatever you wanted. You use it for personal purposes, you could use it for investment, you could use it against your business. Now the $100,000 is gone if it's used for personal purposes. So you no longer get the interest on that, which is probably about, in today's interest rate environment, is probably about $3,000 to $4,000 a year. That's no longer deductible. So you still get a substantial amount of interest deduction on the first $750,000. However, those going into the high end of the market and want to borrow more, they're not going to get the deduction anymore.
Now let's talk a little bit about the state and local tax deductions, as we call in the industry SALT. So the previous law allowed all property taxes paid to state and local government could be claimed as an itemized deduction. So how is that different now?
Well, Jeff, under the new rules, the limit on any type of state and local deduction, be it property, be it income, or be it sales tax, is capped at $10,000. So a lot of people in the Northeast and as well as the California, the blue states that have high income taxes are going to be limited on their deductions. However, it's not as bad as people perceive it to be because, for one thing, a lot of people were subject to AMT beforehand, and under the AMT, the income taxes weren't deductible anyway, so they may not be losing anything.
And let me interject, correct, AMT, what is that exactly?
Alternative minimum tax.
Okay.
So there were two regimes. You had your regular tax, you had your AMT tax. The AMT would not allow you to deduct the state and local, and you paid the higher of the two. A lot of people were caught in that trap. So they're not necessarily losing anything. And furthermore, overall the rates are coming down for everybody. So if you look at the taxable income, you may end up paying less even without this state and local deduction. The third thing to keep in mind is New York City tends to have lower property taxes than most other places. So you may be getting that $10,000 deduction for your real estate taxes. Even in the suburbs, I think they're going to suffer more.
Yes, that may be a perfect opportunity for those who live in the suburbs to consider selling and moving back into the city.
Right. And I'm curious, based on the new law, have you seen any change in this in buying patterns?
I haven't noticed change with my clients at the moment. I think what I advise them is that we live in a global market space in New York, so the buyers will shift to maybe investors, because investors at this point aren't affected by this in their second properties. So though if you choose to hesitate under the guise that you may get some price drops in the property, that may not happen. Now, the one caveat is if the property is priced accurately, then it'll sell. However, if you think it's going to drop as a result of the taxes, you're just going to get a different type of buyer that comes in. And it's still unknown what's going to happen with international buyers. They may jump in and jump in as well. So I just tell my buyers, if they are prepared to purchase a property, I wouldn't let the SALT, though it can impact it, I wouldn't let that be a determining factor in not moving forward.
Well, first of all, if you're considering it as investment property, the limitation on the state and local deduction for property taxes is inapplicable if you're renting it out, or else you can capitalize it against the property. Second of all, now may be a time for people to consider investing in city properties, even for residential purposes, because the prices are softening for other reasons, and they will not stay, they're not going to drop as much as they might in the suburbs, or may not drop at all as a result of this limitation on the SALT deduction.
So then there were many proposed tax changes, some of which didn't go through, but we kind of dodged a bullet by avoiding some. So of those that were on the docket, which would you say could have really had a negative impact on the residential real estate transaction?
Well, Jeff, I think that the biggest save was that they decided not to change the holding period for exclusion of capital gain on the sale of principal residence. When you sell principal residence, as long as you meet the holding period, you can exclude it up to $500,000 of capital gain if you're married, $250,000 if you're single. And the holding period under current law, as it existed, was you had to hold it 2 out of the last 5 years. So you had to reside in the residence for 2 out of the last 5 years. They were considering changing that to 5 out of the 8 years. That would have stretched out the holding period. That would have prevented people who wanted to avail themselves of the exclusion from selling the property. The turnover would have been less, and I think a lot of people would have held out. So that's a big save for the industry. It's also a big save for people who want to move on, sell the residence, maybe buy into something different, or retire or leave, whatever they're thinking of doing. That's a big save for them as well. So that could have been much more harmful to the industry than even, let's say, the loss of the deduction on SALT or the cap on interest.